Deepika ji, you can start the session. We are live.
A very good afternoon to everyone. I, CA Deepika Gudgutia, moderator for today's session. I welcome our speakers for the day. And before we proceed, let's know more about CPE committee. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for the webinar on Audit of Charitable Institution and Government Assistance to MSME under PMEGP scheme. In a short while, we will start this webinar. The accounting profession is undergoing a transformation worldwide. With the change in the global arena, the role of chartered accountants has gained more significance over the years. Today, business and society cannot visualize itself without the profession of chartered accountancy. To ensure our members maintain high ethical standards in providing professional services, the Continuing Profession Education Committee of ICAI is undertaking relentlessly efforts to impart and equip its members with the relevant technical knowledge in the form of conferences, seminars, lectures, workshops, webcasts to hone their professional skills. We are pleased to inform that the ICAI is organizing its first ever Global Professional Accountants Convention, GLOPAC, on the theme Connecting the Globe, Creating Value from November 24 to 26, 2023 at Mahatma Mandir Convention Center, Gandhinagar, Gujarat. GLOPAC is being celebrated as a mega event to display the important role that the accountant profession has been playing in building stronger and more stable economies around the globe. It would provide an opportunity to the global market to network with the best F&A talents in India. Before we go ahead, let's have a view on the short video.
It gives me immense pleasure to announce that the Institute of Chartered Accountants of India has decided to organize its first ever Global Professional Accountants Convention, GLOPAC, on the theme Connecting the Globe, Creating Value on November 24th to 26th, 2023 at the Mahatma Mandir, Gandhinagar in India. GLOPAC is being celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of our country.
Globalization has made the world one village, and the services of chartered accountant are also available globally without any boundaries. The Institute of Chartered Accountants of India is also devoting significant efforts towards global networking. The convention shall be attended by more than 3,000 delegates from around 40 countries. I would like to extend a warm welcome to the fraternity on behalf of ICI to attend and participate in the first ever GLOPAC.
ICAI is geared up to welcome delegates from across the globe at the GLOPAC.
So let's not waste any more time and start with our session. So today we have our first speaker, CA Brijesh R. Shah. He is a graduate in commerce from BGVM and stood second in SP University in year 1997. His area of practices involve NGO audit, financial and internal audit, income tax, and management consultancy. He had also addressed and presented papers at various seminar and conference on FCRA, taxation of trust, etc. He is a regular faculty at training workshops for NGO organized by various forums. I, on behalf of ICAI, welcome you, sir, and the stage is yours. Vijay, sir.
Yeah, very good afternoon to all. So today we will be today's sessions. It's a CP committee of ICI. It is organized by CP committee of ICI, and I'm thankful to chairman of the committee, CA Purushottamji, who is a very good friend of all of us, most of us. Is very approachable. Vice chairman, CA Gyan Chandra Mishraji. My co-speaker for the day, CA Jatin Jajalji. I have shared on few occasions a dais with him, and a very lovely person. A moderator of the day, CA Deepika Gutiaji. I think I have delivered session at Vapi branch in June only, and it is a repeat telecast for you because at Vapi branch also I have covered on almost on same topics.
Yes.
So it is my honor to share my views on recent amendments and audit reports for charitable trust on today's program. To begin, as a committee chairman, CA Purushottamji, with his name, I can remember Bhagavad Gita because of Krishna, because Krishna is said to be Purna Purushottam. And allow me to quote a few shloks from Bhagavad Gita and Sushobhitas. Vidya prashasyate loke, vidya sarvata gaurava, vidya dhanam sarvadhan pradhanam. Knowledge is extolled by everyone. Knowledge is considered great everywhere. I think government is making so many amendments as far as charitable trust and organization are concerned over the period. If you go back for last 2 or 3 years, and uh, personally feeling that amendments related to charitable trust are tremendous. And I think government is also believing in Bhagavad Gita. I again quote one verse for 1720 of Srimad Bhagavad Gita. Deshe kale cha patre cha tadanam satvik smrutanam. Donation given at proper place, time, and to a deserving. It's said to be a sattvic, pure donation. So I think government wishes that transparency and systems are involved, or it is improve in a functioning of a charitable trust also. And so I think major amendments are there in last 2-3 years. Today's flow of session, instead of discussing year-wise amendments, what I will try to do that I have compiled topic-wise, that I will take a few topics. We'll discuss a little bit about their background and what are the amendments in last 2 or 3 years and how it will affect functioning of a charitable trust, and moreover and more importantly, how it will affect our reporting requirement. So I will try to cover corpus and borrowed funds by trust, accumulation of income, section 80G. Obviously, one of the topic is audit report, and if time permits, I don't think so that in 1 hour that is possible, but if time permits, I will discuss two recent Supreme Court pronouncement, which is, I see that it's a far-reaching impact on functioning of trust. So let us begin with uh, uh, as I said, that corpus and borrowed fund. So if I give background of a corpus, the term corpus has not been defined in the Act. In a broader sense, a corpus is the capital of an organization, and therefore such receipt shall be added directly to the corpus. One can say that corpus is like a capital of organization. According to Section 11(1)(d), any voluntary contribution received by a trust or institution created wholly for charitable purpose shall not be included in the total income. If I give background, Section 11(1)(d) was introduced by Direct Tax Laws Amendment Act 1989 with effect from 1/4/89, and the words not being contribution made with a specific direction that they will form part of the corpus of the trust or institution were deleted from Section 224. What does it mean? That earlier it was not part of income. Now it's a part of income of a trust, and it has been given benefit under 11(1)(d). Recent amendments that Section 11 provided that corpus donation given by a charitable trust to another charitable trust registered under Section 12A or 12AA was not considered as application of income. So one trust, if wishes to give corpus donation to another trust, then if donee trust is claiming benefit under Section 11(1)(d), then donor trust will not be in position to claim that amount as utilization. So earlier, prior to this amendments, donor trust was getting a deduction, it was possible for donor trust to get a benefit of Section 11, or to that a donation as a corpus to another trust was included in computing 85% utilization, whereas now it is not possible.
Sir,
Yes. Hello.
so
Yeah.
you have not shared the screen yet. Done, sir.
Here it is. Yeah, it is available. No, now I have shared, I think.
Yes,
Yeah.
yes, sir.
So sorry. Application out of corpus shall not be considered as application for charitable or religious purpose. So not only donation given by charitable trust as corpus to another trust, any utilization out of corpus will also not be available for consideration as a application for charitable or religious purpose. So any amount utilized from corpus is not available at the time of computing 85%. However, it is very important, when it is invested or deposited back into one or more of the forms or more specified in subsection 5 of previous year, such amount shall be allowed as application in the previous year in which it is deposited back to corpus to the extent of such deposit or investment. So in a broader sense, corpus is such amount which income out of that fund is to be utilized for the purpose of trust. Capital should remain intact. So the obvious reason for this amendment is that to retain the capital portion available with trust and to avoid double deduction. Government is of belief that many trusts are transferring funds as a corpus, and a rotation of funds are made among various trusts. So I think to many extent, but this provision will stop that. Accounting of corpus donation and borrowed fund. Investment is necessary for corpus donation to made as stated in section 11.5. It must be earmarked separately as corpus investment or deposit. Any amount withdrawn from the above corpus investment or deposit and utilized for the object of trust will not be considered as application of income. So nowadays, each trust, in my personal opinion, will require to have separate earmarked corpus investment in their books of account as well. So they can trace or they can find out that whether the corpus donation which is received during the year is properly invested or not. Because at the time of assessment, at the time of filing income tax return, at the time of filing audit report, it is required to mention separately about corpus donation, receipt of corpus donation, at the same time, investment of corpus donation. So it is necessary for each institution to have separately earmarked corpus investment ledger in books of account itself. Any amount withdrawn from above corpus investment. So any reduction in investment will be a questionable, and that will be deducted from the application of income. So one has to be very careful. Each institution is required to maintain investment matching with the corpus donation. Deposits back the said amount in the corpus bank account in the same year or subsequent year from its other normal income. Such amount will be considered as application of income. So if I give example that during the year trust has received 1 crore rupees of fixed deposit, 1 crore rupees of corpus donation, it has invested 1 crore rupees in month of November. Next month they require some urgent funds, and they have withdrawn that investment to the extent of 50 lakhs and utilized money. Again, out of their other income before 31st March, if that 50 lakh is invested back, then full 1 crore rupees will be available as a corpus and as specified under section 11(1)(d). If investment is not recouped, if it is not reinvested properly to the extent of 1 crore, that shortfall of investment when compared to corpus received during the year will be deducted from the total utilization of the trust. If you make out at the time of filing return also, now source of fund is required whenever we are writing expenditure utilization of trust in income tax return, or even in a new audit report in 10B or 10BB. It is specifically asked that if in case of a deficit, that out of which fund it is utilized. So to accounting of corpus donation and borrowed fund and its investment is very much important now. This is it is now provided that if any trust includes any temple, mosque, gurudwara, churches or other notified places, and the trust has received any voluntary contribution for the purpose of renovation or repair of these places of worship, the trust will have an option to treat such contribution as part of the corpus. This is applicable to those notified religious places only. Corpus amount shall be used only for this specified purposes, and the amount not utilized shall be invested in specified investment listed in section 11(5). These are the amendments made by Finance Act 22. If any of the above two conditions are violated, the amount will be considered as income of the trust for the year in which such violation takes place. A very important amendment done in Finance Act 2023, depositing back into corpus or loan. I have missed that word loan, but it can be corpus and the provisions of loans that are going simultaneously only. So depositing back into corpus shall be considered as application for charitable or religious purpose only within 5 years of application from the corpus or from the borrowed fund. So if in any year any utilization is done out of corpus or out of borrowed fund to the extent of utilization out of corpus or borrowed fund, that 11(1) will not be available. And if it is reinvested back, deposited back to corpus, or when the repayment of loan take place, it is available, that repayment or depositing back is available only for a period of 5 years. So here, a very much alarming situation is for those trusts which are having a borrowed funds. So in any case, whenever a trust approaches a bank or any financial institute for a borrowing of funds for construction or for any other projects, repayment period, trust has to be very careful because now repayment of loans or depositing back is considered only for the period given is allowed is only for 5 years. Application out of corpus or loans or borrowing before 1/4/2021 should not be allowed as application for charitable or religious purpose when such amount is deposited back or invested into corpus. So 1/4/2021 is the cutoff date. One has to carefully remember this, that any utilization out of corpus or borrowed fund prior to 1/4/2021, and if it has been reinvested or repayment of loan is done, then that repayment or reinvestment will not be considered as application. So by introduction of this amendment, I think the department of ministry is having that idea that prior to 1/4/2021, each trust has taken a dual benefit. Means at the time of utilization also and at the time of repayment. So up to they have kept 1/4/2021 as the cutoff date. But one thing which ministry I think misses that set off of loss or carry forward of loss is not available anymore available to charitable trust. So in case if I share some practical example that in financial year 2021, if some trust has taken or borrowed a fund from bank for the construction of a college building, which is of 2 crores, and obviously in that year, as the fund is utilized out of borrowed fund, that deficit is not available to carry forward, and uh, repayment of that loan, obviously that is to be made out of income of future years, and that repayment of loan, as the loan is taken prior to 1/4/21, that is not available to be considered as application. So it's a very harsh amendment as far as trust is concerned, and I must say that some sort of representation is required, that if any trust is in a position to establish that dual benefit is not taken by trust in the year of procuring that loan, and so this deadline of 1/4/2021 can be liberated, or can be one can say that the government may think of that some provision should be added or some amendment should be there. Now, moving to another topic for the day, that is accumulation of income. As I said that I am sharing this all topics in 3 parts: background, amendments, and effect on trust. So accumulation of income, the background is that by virtue of Finance Act 2002, 85% of the income needs to be applied for charitable purposes. Prior to this, 75% was required, and 25% was available under Section 11(1) and 1A, and 25% was unconditional accumulation, which is now from 2002 onwards, it is 15%. In the case where the income is derived but not received, the organization have the option, with the consent of the assessing officer, to consider the income accrued but not received as deemed application. So in any year, if a trust is falling short of utilization of 85% of its income, then trust has 2 options, rather 3 options. One option, first option, very obvious, to pay tax on shortfall of utilization of funds. The second option, that they can file form number 9A and opt for to consider the income accrued but not received as deemed application, which is to be added in the next financial year, and trust has to utilize. Another option is to uh, accumulate fund under section 11(2) by filing form number 10. So if the organization is unable to apply 85% of its income, it can accumulate by applying to the assessing officer in form number 10 under section 11(2) before the time limit prescribed in section 139(1). The exemption availed on accumulated income will be withdrawn under the following circumstances under section 11(3). So these are the various conditions when benefit of Form 10 under section 11(2) can be withdrawn if they are applied for purposes other than for which they were accumulated, if the accumulated income ceases to remain in any of the modes of investment prescribed under section 11(5), if the accumulated income is not utilized within the period of accumulation. The Finance Act 2002 has inserted another clause wherein any donation given to another charitable organization out of such accumulated income will also disentitle the donor organization of the exemption. So these are the main conditions. If we simplify this, that 11(3) will be attracted in case where accumulated income is utilized for the purposes other than for which it is accumulated. So if the purpose which is mentioned in form number 10 at the time of opting for this accumulation, if it is mentioned education, an amount accumulated fund is utilized for any other purpose than for educational purpose, then 11(3)(a) will get attracted and it will become taxable as per 11(3). If the accumulated income ceases to remain, all accumulated fund has to be invested as prescribed under section 11(5). So if any mode other than 11(5), 11(3) will be attracted. If accumulated fund is not utilized within the period of accumulation, accumulation can be done for the period of 5 years. In 2023 Finance Act, there are some major amendments that we will be discussing separately. But this 11(3)(c) earlier it was getting attracted in 6th year. If 5 year, if it is not utilized, then it will get attracted in 6th year. But from as per amendment made in Finance Act 2023, it will become taxable in 5th year itself. Another very important insertion by Finance Act 2002, that trust cannot make any donation to another charitable trust out of accumulated fund. So this is very important. The accumulated fund has to be utilized by trust on its own only. It cannot be considered as utilized by way of a donation to another trust. Finance Act 22, effective from assessment year 23-24, to provide that if the entire amount of the accumulated income is not utilized up to the end of 5th year, the unutilized amount will be considered as income of the 5th year and will become taxable in that year. A very important section, new section has been inserted, section 115 BBI. It is very significant because it's a special rate of tax, and it is discussing about the scheme of taxation under various conditions for charitable trust. If I share with you, up to now, before insertion of this section, there was no specific scheme of taxation in case where section 11(3) gets attracted. But now with insertion of section 115 BBI, Income Tax Act has now given specific scheme of taxation. One can say that a scheme of taxation in certain conditions. Earlier, it was becoming a part of income in the 6th year if accumulated amount is not utilized in 5 years, and any expenditure, any utilization of trust can be set off against that income in 6th year. But with insertion of new section 115 BBI, it is altogether different. And effective from assessment year 23-24, charging tax at the rate of 30% plus applicable surcharges and cess. New section 115 BBI. This rate of tax will apply to registered charitable trust, religious trust, institution, etc., claiming exemption under Section 1023C and 11 in respect of the following specified income. Very important. The point first, which I think we all missed out, and this came in every session from I have taken almost some 10 to 15 sessions on various forums, various branches. I have covered this point everywhere, but not a single question I have received for this. First point, income accumulated in excess of 15% of the income where such accumulation is not allowed. This is many CA now, many of my friends, many tax practitioners are asking us with a query, are coming to us with a query that their software, some mistake in their software, saying that surplus is of 2 lakh for a trust and software is calculating or computing tax for that. I said there is no mistake. It's a because of insertion of section 115 BBI, and very importantly, one Ministry of Finance has a curriculum dated 3rd March 23. Immediately after Union budget got approved, and this 3rd March 2023, there is a curriculum for dated 3rd March 2023, whereas they have drafted income tax return ITR 7. They have made the necessary changes in ITR 7 for this 115 BBI. So up to now, the trust were enjoying basic exemption of 2.5 lakh rupees. Now onwards, a single rupee, a 1 rupee shortfall in a utilizations. Say a trust income is 5 lakh rupees. 85%, so say for 4 lakh rupees, 85% will become 3 lakh 40,000, and if trust has utilized 3 lakh rupees. So on 1 lakh rupees, earlier there was no tax because of a basic exemption of 2.5 lakh. But now onwards, it will become taxable under section 115 BBI, which is 30% plus surcharge plus cess. So practically it is more than 35%. So a single rupee surplus can lead to payment of tax for a charitable organization. So first point is very important, which I think main victim of this amendment are various small trusts which are unable to utilize their 85%, but their gross receipts are not much, which are having a surplus up to 2.5 lakh, and they were getting shelter of that basic exemption, and they have saved from payment of tax, but from because of this insertion of new section, they have left with two options, that either they can pay tax at a 35%, or they have to go for that procedures for filing form 9A or filing form 10 for accumulation, or to create option. The second condition where the section 115 BBI can get attracted is where the income accumulated by the charitable trust or institution is not utilized within the permitted period of 5 years and is deemed to be the income of the year when such period expires. This is very important. If trust has accumulated fund for 5 years, if it cannot utilize in 5 years, in 5th year itself, unutilized amount out of that accumulated fund will straightway become taxable at 35%. Very harsh. Earlier it was so it means that 11(1)(a), that 15% will not be available for such income. It's a straightway available taxation scheme is provided, that in such cases any unutilized or any shortfall in utilization of that accumulated fund will become taxable. Income which is not exempt under section 1023C or section 11 by virtue of provision of section 13(1)(d). This will include value of benefit given to related person, income from investment made otherwise than what is provided in section 11(5). Income which is not excluded from the total income of a charitable trust under section 13(1)(c), This refers to the value of benefit given to related person. Income which is not excluded from the total income by section 11(1)(c). This refers to income of the trust applied or for objects outside India. I will say that these 3 points are a welcome change. I'm very positive person, and I look for some sort of positiveness out of harsh amendments also. So out of this harsh amendment by insertion of new section 115 BBI, I can say that this new section, section 13, the threat of section 13, which is a payment to unreasonable payment to related person, or investment made other than 11(5), or value of benefit given to related. All this sort of earlier days, it was a threat of losing total benefit of section 11 and to loss provisions registration under section 12. So now by payment of tax, at least that positiveness is that one can move ahead. If in case mistake is happened, then by payment of tax, by payment of penalty, trust can move on rather than losing their exempted status. Cash or mercantile system of accounting with effect from assessment year 22-23. If a charitable trust is maintaining accounts on accrual basis of accounting, it is now provided that any part of income which is applied to the object of trust, the same will be considered as application for the object of trust only if it is actually paid in that year. So for purpose of utilization, for purpose of computing 85% of under section 11, cash basis is compulsory for trust. Even if trust is required, trust is maintaining books of account on mercantile basis, the actual expenditure made only will be available for considering or for computing 85% of utilization. So any provision, any unpaid expense will not be available for considering the total utilization. If it is paid in subsequent year, it will be considered as application of income in the subsequent year. New provision of levy of penalty. A new section 271 AAE is added in the Income Tax Act for levy of penalty on charitable trust and institution claiming exemption under section 1023C or 11. Charitable trust claiming exemption under section 11 gives an unreasonable benefit to author of the trust, trustees, or other related person in violation of provision 21 of the section 1023C or 13(1)(c). The AO can levy penalty on the trust or institution 100% of the aggregate amount if it is noticed for the first time, and if it is noticed again in subsequent year, it is 200% of the aggregate amount of such income. So one has to be very careful at the time of making any transaction with a related person or with the trustees for a justifiable amount or reasonable amount. So the test of reasonableness should be done at the time of making any transaction with related person or with trustee by a charitable organization. If trust fails to establish that genuineness or reasonableness, it can attract 100% in first year, penalty of to the extent of 100%, and 200% in the subsequent years. The next points are section 80G. First, we will discuss the recent changes or Finance Act 2020. Clause 8 and 9 are added in section 80G5 from 1/10/2020. Every trust institution holding section 80G certificate will require to file with the prescribed income tax authority particulars of all donors in prescribed form number 10 BD on or before 31st May following the financial year in which donation is received. And the trust or institution is also required to issue a certificate in prescribed form 10 BE to the donor about the donation received by the trust or institution. In the event of failure, trust is required to pay late fees at a fees of rupees 200 per day for the period of delay under new section 234G, and penalty also to the extent of minimum 10,000, which may extend to 1 lakh rupees, levied under section 271K. If you have observed that in a current year for a charitable organization, if you download Form 26AS, AIS, TIS information for charitable trust, one more information is getting downloaded, that is voluntary contribution or donation. So even in income tax return and in audit report, one is required to reconcile total voluntary contribution or donation received by a trust and voluntary contribution or donation reported in Form 10BD. So at the time of filing Form 10BD and a total amount to be claimed as voluntary contribution, one has to be very careful. If that reconciliation is not proper, if a wrong column is selected at the time of filing income tax return or filing audit report in 10B or 10BB, that may lead for a anonymous donation. That donation may lead to, that figure may lead to anonymous donation, which can become a taxable under section 115 BBC. So one has to be very careful at the time of reporting this. So 10BD reporting is important, and equally important is to reconcile that figures at the time of filing income tax return and audit report. Audit reports. As you all know, up to now, two audit reports are there, Form 10B and for 10BB. 10B is for a trust which are required to get their books of account audited under Section 12A AC, and 10BB was required for those trusts which are required to get which are recognized under Section 1023C and required to get their books audited. Effective from 1/4/2020, it is provided that the audit reports in Form 10B or 10BB and subsequent years shall be filed with the tax authorities 1 month before the due date for filing the return of income. So 30th September was the last date. This year it is extended for a 1 month because of the new forms and the schema, and the utility was not available for Form 10B. So this 1 month extension is there. So for a financial year 22-23 and assessment year 23-24, last date to submit Form 10B or 10BB is 31st October. And the filing of return is 30th November. In normal circumstances, filing of audit report is 30th September and filing of income tax return is 31st October. These are two very important circulars in case of delay in filing Form 10B. Circular number 2 up to 2020 dated 3rd January 20. It authorized CIT of income tax to admit application for condonation of delay in filing Form 10B for assessment year 18-19 and subsequent years if delay is up to 365 days. And circular number 15/2022 dated 19/7/22 extends powers to principal CCIT to grant condonation of delay in filing Form 10B where delay is beyond 365 days and up to 3 years for assessment year 18-19 and subsequent year. This is very important, a great relief in hands of charitable trust. If you verify that many pending demand in case of trust is only because of late filing of Form 10B or 10BB, it may happen that late acceptance, if auditor has submitted audit report in Form 10B or 10BB within stipulated time period, but if it is accepted late by trustees, then also it can be considered as a belated filing of audit report only. And in such cases, CPC is treating a trust as AOP and charging tax on gross receipts at maximum marginal rate. So many trusts are facing a huge tax liability because of late filing or late acceptance of audit report. So these two circulars are of a great help to charitable trust. And my personal experience with CIT Gujarat, CIT exemption Gujarat and CIT exemption Maharashtra, that in these two states, CIT exemptions are taking a very liberal view. If a delay is less than 15 days, only on the basis of application with basic documents like 12A and audit report, that they are condoning the delay. If a delay is more than 15 days, some justification for the delay of filing Form 10B or for accepting 10B. But these two are very important in my opinion. And in case of any pending demand, which is because of late filing of Form 10B, shelter for these two circulars can be taken by charitable trust and can apply to CIT exemption for condoning the delay. Income Tax Amendment Rules 2023. This shall come in force with effect from first day of April 23. Form 10B. The report of audit of the accounts of a trust or institution which is required to be furnished under Section 12A, where the total income of such trust without giving effect to the provision of Section 11 and 12 of the Act exceeds rupees 5 crore during the previous year. Such trust has received any foreign contribution during the previous year. Such trust has applied for any part of its income outside India during the previous year. In all other cases, Form 10BB is the audit report. So 10B is required by those trust or institution. Sorry, I have missed a word, Section 1023C, but please consider that not only 1012A, but under 1023C also it is common. Earlier, Form 10B was for 12A and 10BB was for 1023C. Now, conditions are such that if receipts of trust are exceeding 5 crores, trust has to file Form 10B. If trust or institution has received any foreign contribution, then also 10B, or any application of income is done outside India, then also 10B. In all other cases, Form 10BB. So all trusts whose turnover is less than 5 crores are required to file Form 10BB. Now, one very interesting matter of interpretation, that point second, that such trust has received any foreign contribution during the previous year. The reference in the rules is given of FCRA, Foreign Contribution Regulation Act. And as per the language of form, it means only donation. Foreign contribution doesn't mean only donation. Any interest income or any income out of investment which is done out of foreign contribution can also be considered as foreign contribution. So in case if trust has not received any donation as a foreign contribution during the year, but has earned any interest out of fixed deposit made through foreign contribution, then that interest can also be considered as a foreign contribution. So this is a point of debate. Clarity is not there. So in those cases, whether 10B or 10BB, that's a big question which is unanswered. And by looking at the columns of audit report, I think department is having a feeling of only donation and they are not considering interest. But the reference in rules is given of Foreign Contribution Regulation Act, which include interest out of investment, out of foreign contribution is also to be considered as foreign contribution. So little confusion is there, but otherwise 10B and 10BB is segregated in by way of turnover and for foreign contribution. A very important change that in case of Form 10B, auditor is expected to provide true and correct opinion for all the particulars in the annexures. It is not true and fair, it is true and correct. So, and there are so many annexures in Form 10B. It is a 42-page audit report with various annexures, which include all annexures are almost similar to ITR 7. So whatever is falling under ITR 7 is becoming part of Form 10B also. an auditor is required to provide true and correct opinion for all such annexure. If I give you example of that, one of the annexure includes a payment made to any person in excess of 50 lakhs in a year. So this is a tough task for auditors, that they have to get that information. And because many trusts are following their books of accounts on cash basis, they don't even maintain party-wise ledgers also. So it is very difficult as far as our fraternity is concerned to collect this information. Some other important amendments: enhancement in the limit of receipts under Section 1023C with effect from financial year 21-22. It provides that 1023C can be claimed if aggregate annual receipt of such institution does not exceed rupees 5 crore. Earlier time that limit was 1 crore rupees. Now it has been extended to 5 crore. But along with that, one more clarification is attached, that prior institution, individual institute turnover can be considered. Various High Court judgments were there that various educational institute falling under same trust, the 1 crore limit can be considered separately. But now it has been amended that combined turnover should not be, or a consolidated turnover should be 5 crores. From same financial year, set-off of deficit of earlier years is not allowed. It is provided that if trust or institution has incurred expenditure on the objects of trust in excess of its income in any year, the deficit representing such excess expenditure will not be allowed to be adjusted against income of the subsequent year. So various High Court judgments are now overruled by this amendment. So many trusts which are having a genuine deficit cannot claim that, carry forward that, and so many in judgment, various High Court judgment in favor of SSE are of no use now. Important amendments in Finance Act 23. The donation made by a trust or institution to another trust or institution shall be treated as application only to the extent of 85% of such donation. Finance Ministry is of the opinion that there is a leakage of revenue. Donor trust is claiming amount 100% as application, whereas donor trust is any objection, but only thing that donor trust has to compute his application. The third and fourth proviso to subsection 2 of section 12A omitted that granted benefit of exemption provisions for earlier. Now this proviso, second, third and fourth proviso of subsection 2 of 12A were very important. This mainly was for those trusts which was not registered under 12A from initial years, but it got subsequently got themselves registered under section 12A. So by shelter of this second, third and fourth proviso, they were having some Hello, am I audible?
Yes, now audible.
Yes, sir.
I think some internet issue happened, I think, but hello.
Hello.
Am I audible?
Yes, sir.
Okay. I think some internet issue. So whether my screen is shared.
No, sir, your screen is not shared.
It is coming message here. My internet connection some issue. I think it is becoming unstable. That's why. Am I audible? But can you hear me?
Yes, sir. Yes, sir.
Yeah. So I'm just moving ahead, even if my screen will get shared. Some issue with internet, I suppose. But I have to conclude in 5-6 minutes also. So I'm just covering that.
Yes, sir.
Second, third, and fourth provision of Section 2 of 12A, which are very important for those trusts which miss to get themselves registered under 12A from initial years and subsequent.
So I guess there is some internet issue at Vijay's sir end. So without wasting more time, we'll quickly hear to our next speaker and we'll take all the question session at the end of the session for both the sessions together. So before that, I would like to welcome our second speaker, CA Jatin Jalal. He has specialization in the area of finance, audit, subsidy, and taxation. He is a visiting faculty of ICAI Rajkot, Ahmedabad, and Mumbai. He has written books on subsidies and investment in Gujarat. He has also represented ICAI at Asian Financial Forum, Hong Kong. I welcome you, sir, on behalf of ICAI. The stage is yours.
Thank you. Thank you very much, Devika ji. So after the session of this income tax, so we are now venturing into a totally different era. So let us discuss what it is about, the Prime Minister Employment Generation Yojana. Basically, it is for the very small units who are really wanted to start some manufacturing or services. So I request all the members who are really in practice, even a small client comes and says that they wanted some loans because they wanted to purchase some machineries, always check out this possibility of getting this subsidy, because the amount of subsidy is as high as up to 35% of the project cost. Now, 35% of the project cost also includes the working capital. So I strongly recommend that always cross-check with the schemes available for your clients in such segment. So this is only the scheme where even the working capital subsidy is, working capital is considered for the subsidy part. This subsidy is available at pan-India basis. So anyone from Delhi, anyone from South, anyone from Maharashtra, anyone from Northeast side, the all can apply because this is a central government scheme. The quantum of subsidy is as high as we have discussed, that 35%. So if the project is, let's say, of 50 lakh rupees, then they will be getting the subsidy of 17 lakh rupees. So always cross-check whenever it comes any opportunity for any new project by any of the client to get the subsidy under this scheme. However, the applications is a differently module. I mean that many subsidies are to be applied after the sanction and disbursement of the term loans. However, PMEGP subsidy, you need to apply first at the portal of the government. Later, the government submit to the banks, and then after the bank get the sanction of the loan, and bank will put up the claim for that. So for my practical experience goes on that I have seen a lot of members who are asking that the bankers are not interested into sanctioning this PMEGP loans. So better what we used to do in our offices is that first we approach to the bankers, give them the details. They are more concerned about the securities that is going to be offered to them. And if they are convinced in principle, then and after that, you apply under the PMEGP scheme to the government, and later, based on the IFSC code that you have given to them into the subsidy application, they will forward this to the bankers. So always cross-check, because otherwise it will be too much time consuming for you also, that at the end of the day, if the loan is not getting sanctioned, it doesn't make any sense to spend a lot of time on that behalf. Here, Bridges sir was discussing that report of 1 year is of, let's say, 42 pages. Frankly speaking, I'm not practicing the trust, so I was quite surprised that 42 pages is the normal. But here, if you really wanted to practice into PMEGP, the GR for that, the GR is just of 26 pages. And can you believe that? The whole scheme, if you really wanted to read out, you have to read just 26 pages. So I strongly recommend each and every one to practice in this area. Let us go through with the slides. So this scheme, the abbreviation stands for the Prime Minister Employment Generation Program, that is operational since 2008. This is in operation since 2008. Amount is getting disbursed also. They are very fast also. What we have done up to the June month is right now the subsidies have already been credited to the beneficiaries account also. This is administered by the Ministry of MSME Delhi, and it is implemented by KVIC board, KVIB, and DIC. So what is the nature of assistance that we are going to receive under this scheme? For the general category, the margin that you need to keep for the loan purpose is just 10%. So if you are applying under the scheme, the banker generally takes the margin for the term loan of 25%, and for working capital, they are asking for margin up to 40%. In this case, if you are applying under this scheme, the banker cannot ask more than 10% as a margin. So the borrower has to invest only 10%. The rate of subsidy in case if the project is implemented at an urban area, the rate of subsidy is 15% of project cost. Here, the project cost includes the even construction of building, plant and machinery, and working capital. All are included to consider the cost of the project. And the same rate of subsidy, if the unit is located at the rural area, then it will be 25% of the project cost. In case of SC, ST, or a woman entrepreneur, or a minority entrepreneur, or it is in aspirational district, a separate list has been provided. If it is located in that district, then your subsidy will be higher, 10% higher. So rate of subsidy, if the unit is in urban, then it will be 25%, and rate of subsidy, if it is into the rural area, then it will be 35%. So what is the basic condition for this one? This one is the maximum cost of the project for the manufacturing unit is 50 lakh rupees. And for the service unit and for the business, even this subsidy is eligible for traders also. So in such cases, it is 20 lakh rupees is the maximum, that should be the maximum cost of the project. However, what happens if the cost is higher than 50 lakh rupees? In such cases, they are allowing, but the restriction to give the subsidy is up to 50% of 35% or 25% of the maximum 50 lakh rupees. So suppose if your project cost is, let's say it is 75 lakh rupees, then also you can apply under this category in this scheme. And for this, the maximum cost of project will be considered 50 lakh rupees. Is this for the new unit? Absolutely yes. This is only for the new units that are coming up. However, in case if PMEGP scheme has previously been taken the benefit of that, or any mudra loan has been taken by the borrower, and one-time expansion has been done, then also that is eligible. So that is a second loan for upgradation of the existing PMEGP, REGP, or a mudra units. So here they are very clear on the point that expansion in case of existing PMEGP, REGP, or a mudra units will be eligible for the second time subsidy. However, here the margin would be 10% for all the category. Rate of subsidy will be 15% only. 25% on to the northeast side. However, here for maximum units, it will be 15% subsidy. Other conditions. The proprietor age should be more than 18 years. Is the partnership or a private limited company eligible? No. This is only for the proprietor and your entrepreneurs only. So any individual can only apply for this subsidy. In case if the project is more than 10 lakh rupees, then the owner's education must be above the 8th standard. This is very important. They are even demanding the mark sheet of latest mark sheet of the borrower or the beneficiary. Project without the capital expenditure is not eligible. Here working capital subsidy is available. However, exclusively if you are looking for working capital loans, then this subsidy is, you are not eligible under this subsidy. You must have capital expenditure. Cost of land is not to be included while calculating the cost of project. However, in case if your factory is a leased factory, in such cases they have allowed 3 years lease rental to be considered as a cost of project. However, practically the bankers will not be convincing on this point, so better to avoid in calculation of the lease period of the 3 years. Negative list project are not eligible. So under this GR, they have provided such industries which are absolutely not eligible for subsidy under the PMEGP scheme, and such industries are business connected with meat processing. Any businesses which is being banned by the local government, local authority, with a view to keep the environment factors, then in such cases, this subsidy is not available. Manufacturing of the polythene carry bags less than 75 microns thickness, such project will also not be eligible. And any industry connected with cultivation of the crop and plantation like tea and coffee will also be not eligible. However, the dairy projects like milking through cows, sheep, goats are eligible under this scheme. So this was about the negative list. Then we see trading activities is eligible. Yes, trading activity is eligible. However, the restriction is that the trader should be engaged into the retail outlet of selling the khadi products, village industry products procured from the KVIC, and products that has been manufactured by the PMEGP units, and you are trading into such activities. In such cases only the trader is allowed to claim the subsidy under this scheme. However, apart from trader, all the service sector is allowed. Even the transportation activity is eligible. Suppose anyone is buying the tempo traveler or even for the car. In such cases, if he is utilizing for the services to be rendered as a transporter, in such cases, this subsidy is available to them also, and that will be under the service category. Only one person from one family is eligible for the subsidy. So, what is the family? The definition given is a husband and wife, so far as I have read it into the plain reading. So even in case of husband and wife, if you have claimed the subsidy in husband's name, then again you cannot claim in the second project of his wife. So this was about the basic conditions. Then who are the implementing agencies? That is, one is KVIC, that is Khadi and Village Industry Commission. Another is KVIB, Khadi and Village Industrial Board. And third one is DIC, that is District Industry Center. So in each and every district, the DIC is always available. So it is more approachable rather than KVIC and KVIB. So in case of queries, or before if you are applying to this subsidy, you can meet to the concerned officer at the DIC also. And in case of KVIC and KVIB, in each state, they do have their offices, and even they do have offices at the district level also. You can approach there also. Because it is very important to meet personally with them, because this subsidy has an outlay in the 5 year of 13,000 crore rupees. Out of that, each and every state-wise, they have given the limit up to which they can apply and get the disbursement of fund from the government. So in such case, for example, Ahmedabad has been given, let's say 500 crore rupees subsidy disbursement budget for this year. In such cases, if you are applying today, but before applying, you asked to the concerned district officers that fund is available or not. For example, in Gujarat, right now the Surat's fund has been utilized fully. So for this year, no new application will be entertained by the concerned department. So it is better whether you have to cross-check whether this district's fund is not utilized, then and only then you apply under this subsidy. It is important to note that there is a training to be undergone by each and every beneficiary. The training is of 10 days, or even now, after this Corona period, they have started the online EDP training, entrepreneurship development program they have started, and the entrepreneur must have to complete 60 hours of online training. In such training, they are morely teaching how to handle the business, how to handle the finance, how to handle the marketing. Very good approach being taken care by this department. And a scorecard has to be prepared. A scorecard, when you are applying the subsidy online, there will be a number of questions, and the point has been allocated. That scorecard has been made along with consultation with the Indian Bankers Association, and that is whether this project is viable or not. If you are getting less than 60 marks, you are not eligible for this subsidy. So any project above 10 lakh rupees, a scorecard has to be prepared, implemented, and you have to upload the necessary documents along with the question asked at such portal. Bank finance. So first, as we have discussed, you approached to the concerned DIC or the concerned KVIC or KVIB, and you are satisfied that, okay, the fund is available at the district level. You have applied for PMEGP scheme. Then after that, his application will be moved and approved by the concerned officers, and it will then move to the bankers. The bank has a separate login for that PMEGP scheme. Then after, they will sanction your loan, and then after they will put up the claim. However, note that for the manufacturing unit, working capital component should not be more than 40% of project cost. So as we have discussed, the cash credit facility is also eligible for the subsidy, but the limit for the working capital is that it should not be more than 40% of project cost. So let's say project cost is of 40 lakh rupees. So in such cases, 40% of the project cost is 16 lakh rupees. So your working capital should not be more than 40%, that is 16 lakh rupees. So you can have like 30 lakhs rupees as plant and machinery, 10 lakhs working capital. So total is 40 lakhs. Here, mind well, in making the project report, we generally take the margin for the working capital as a cost of project. We consider cost of project as a land, building, plant and machinery, and the margin for the working capital. And we, on the other side, we take the means of finance, that is the term loan and equities. Here, you can consider the total working capital as a cost of project. That is a plus point. Under the servicing and trading sectors, working capital shall not be more than 60% of project cost. In case of service and trading, there is a limit of 20 lakh rupees. So in 20 lakhs, more than 60%, it should not be there. So working capital or a CC can be 12 lakh rupees and term loan can be 8 lakh rupees. Term loan in service sector may be for equipments you will be procuring or taking the term loans, but exclusively working capital will not be eligible for the subsidy scheme under this. Very important is employment criteria. The government intention is to generate more and more employment by way of PMEGP. The name itself suggests the employment generation. So the capital expenditure divided by the full-time employment created by the project should not exceed 3 lakh rupees in plain areas, 4.5 lakh rupees in hilly areas. What it means to say is that one employee must be engaged or given an employment, or you have to hire for capital investment of 3 lakh rupees. So if your project cost is 30 lakh rupees, the employment generation must be more than 10. So very simply, you divide your cost of project, divide it by 3, and you will get the minimum number of employment to be generated by the unit. Here, you have to apply the subsidy online. It is on the kviconline.gov.in. Very simple process. It is based on the Aadhaar OTP. You can just simply put up the data, and it will throw you the details, and everything is available online. You do not have to physically given any document. Apply online with all the documents to be uploaded. Aadhaar number is must. Very importantly, cross-check that the Aadhaar of that borrower or a beneficiary is linked with the mobile number. And IFSC code of the bank is very important. Once it is gone into the another banker's or another branch code, then you have to again tell to the government department to change or to reject your application. So always take the IFSC code first, where the banker, many times nowadays, many like SBI, BOB, all MSME process are being done at the MSME factory or SMECC branches. So that are the different processing units. So decide which branch you want to park and ask that branch IFSC code at a first stage, and that you need to give it at this application stage. So if everything goes well, your project is being the bankers are satisfied with your project, and they sanction the loan, they disburse the loan, and after the disbursement, the banker has to put up the photograph of the borrowers, plant and machinery invoices, their sanction letter, disbursement, etc. to the KVIB's site or DIC, PMEGP site. And after the submission, the necessary verification has been done from the KVIC or Ministry of the MSME. Then after they release the fund to the concerned bank, the bank receives the fund, and as soon as they receive the fund, they keep that money as a fixed deposit up to 3 years. That is, margin money subsidy is always kept as a fixed deposit for the 3 years. At the end of the 3 years, they visit the unit. A geotagging has also been done. Even in between also, it can be done by the ministry on some sample basis. Your work unit should be working. You should have generated the number of employment. And if you have satisfied all the conditions, that at the end of the 3rd year, the amount will be transferred to your term loan or to your account. So physical verification under this new scheme. This new scheme has been implemented just before, announced before 1.5 years. Previous to that, the limit for the manufacturing unit was, cost of projects limit was just 25 lakh rupees. But under this new scheme, it is up to 50 lakh rupees. And under this new scheme, geotagging, I mean, where your factory is located, that will be tagged by the ministry, and so that they really wanted to ensure that duplications of beneficiary is not going to happen. And at the end of the 3rd year, if you have satisfied all the conditions, then the amount is to be given to you or the beneficiary. However, in such cases, in between, if the account becomes the bad or an NPA, in such cases, the benefit or the subsidy that has been given to the unit, which is in the form of the TDR, has been taken back. The government and the banker has to give that amount back to the Ministry of the MSME. So I hope so. I have justified is quite quick because the topic is, what we have discussed is 26 pages. I'm happy if anyone has any questions, and at the grassroots level, I would love to answer that. Yes, Deepika ji, is there any mode of communication? Is there any question? Yes, Deepika ji. If there is any way out, we can communicate two-way with the audience, and there would be a lot of question, I think so.
The organization
Your voice is not audible. Still not audible. Hello. I'm not getting the voice.
Am I audible?
Yeah, now audible. Yes. Is there any way we can communicate?
So we have questions from the participants.
Yes,
So
yes.
I'll be sharing those questions.
Yeah.
If an organization paid some expenses like rent for the other organization with similar object, is that be treated as transfer of funds and 85% limit of utilization be applied?
Yes, sir.
Jatinji, sorry, this is, I think, pertain to my topic. So I have dropped my topic because of internet in between the way. Say, Deepika ji, what question I got that utilization by way of donation to other trust. In
Yes.
case if a trust is paying any expenditure on behalf of some other trust, one has to first of all verify that whether that expenditure is within the objects of that trust or not. And is there any relationship between that two trust or not? Because Section 13 can be implemented even when a transaction between two trusts also. So one has to be careful when doing this such sort of a transaction. So sponsoring any expenditure or sponsoring any students of any institution will not be considered as a donation. As far as suppose one trust gives a scholarship to some students by way of paying directly fees of that student to another organization. That is, that cannot be considered as a donation by one trust to another trust because that is within the objects of trust, which is educational aid only. But paying rent of one trust by another trust, one has to verify that whether objects allow that and rent is paid for what, and it is an indirect way of donation only. So I'm afraid that 85% will be attracted.
Okay, thank you. The next question is MSME department call came for filing charges of 25,000 to claim subsidy. To expand professional opportunities, loans are also applicable. Is it so?
No, we never come across to such situations. My email ID is available, phone number is available. Just I will be also interested to know because I am a regular speaker on the side of MSME has just invited me to teach their staff about this nitty-gritties of the scheme, and because they do not understand the balance sheet well. So even they will be interested if you can share something.
Okay. What will be the capital expenditure expected in case of trading activity?
Suppose you are making an furniture of your shop, that could be considered as a capital expenditure. However, trading has a very limitations for you should be trading into this KVIC's product, Khadi product, and product manufactured by PMEGP only. So the restriction is, and second thing, there is a limit of 10% of the total fund allotted to any district for traders and service industries, 10% only. So you have to cross-check with the concerned DIC whether the fund is available in such category or not. But the capital expenditure, as I told you, like you will be buying computers, you will be buying cupboards to store these things, that could be considered as a capital expenditure.
Thank you, sir. A trust follows mercantile system. In order to comply with actual payment criteria, it did not provide for couple of expenses of around 30,000 as against actual cash expense of 35 lakhs. Should we modify report or issue EOM?
See, there is no restriction on a method of accountancy to be followed by charitable trust. Trust, option is open for either to follow cash basis or mercantile basis. The only limitation in case of trust is that if trust is following a mercantile system of accounting, then at the time of computing 85%, only actual expenditure, actual payment is allowed. So in that case, or even say previous year expenditure which is paid in current year, that is also available in computing 85%. So one has to verify that how much is actually paid for the objects of trust and accordingly to claim that in Form 10B and in a filing income tax return.
Okay. The next question is to Jatin sir. Is the scheme benefit available to agricultural projects as well?
Agriculturals, there, as I have discussed, even they are allowing, if you are doing milking project, dairy project, even that everything is being covered. Particularly for like farming, if you are asking for particular farming, I need to check the specific questions. I mean, for general, I cannot say, but obviously they are covered.
The next question is, a religious charity is engaged in other charitable activities like education, health, for the poorest of poor, which are not for the purpose of trust. Is this permitted? Sorry?
Can you please repeat the question?
Yes, sir. Yes, sir. A religious charity is engaged in other charitable activities like education, health for the poor, which are not the purpose of the trust. Is this permitted?
Not permit. If object clause is having only religious purpose and no other purpose, then I'm afraid the trust will not get benefit of making expenditure for any purpose other than what is there in your trust deed. Because at the time of registration also, they are asking specifically that objects of trust and any expenditure other than objects of trust are not allowed.
Okay, thank you, sir. The next question, will the point mentioned in section 11.3 subsection D be applicable to a temple which has collected donations and utilized it for infrastructure or development of another temple?
It is
Which is the
11.
11 subsection 3 subclause D.
If any fund is utilized out of accumulation to give donation to other trust, that is not allowed. So if a trust is making expenditure on its own, then it is allowed. If it is giving donation for whatever purpose or for whatever reason to any other trust, then it is not allowed.
Okay. So the next question is, a college was taken over by another party. All the trustees have changed, but new registration is not received till date. But college is still running and earning income. Who will be liable to file return of income since new PAN is not received till now? How to file return?
Say, if a college is being run by any charitable organization and if a trust is taken over, say it's a terminology is wrong that are taken over. If there is a change in trustees, one can say that a change in trustees of that trust. Say trust is altogether a separate legal entity. So when it is if the trust is in Gujarat or Maharashtra, it is registered with the Bombay Public Trust Act. If it is not registered in Gujarat and Maharashtra, then it will govern by Indian Trust Act or Societies Registration Act. As far as income tax is concerned, I don't understand that what is the need of a different or a new permanent account number in case where there is a change in trustees. It's a immaterial that whether two trustees got change or four trustees got change. But I don't understand that what is the need of procuring new permanent account number. Secondly, registration under 12A. It was by 2021, it has become compulsory for every trust for re-registration under a 12AB was inserted, and each trust has done that exercise. So at that time, 12 the subclause AC, subclause 1 of clause AC of section 12A1, each existing trust are required to apply for a re-registration, and they got a re-registration by default for 5 years. That is called permanent registration. If any trust misses to make that application in that year, up to 30th September, which I'm afraid already over, that time was extended. That up to 30th September, if they reapply, if they apply, it can be considered as a valid application and they will get registration from financial year 21-22. But if in any case registration under 12A, re-registration under 12AB is not done, I suggest you that go for form 10AB will apply now instead of form 10A and apply immediately. Otherwise, benefit of section 11 and moreover, tax can be levied on accreted income because that trust is not having any 12A, valid 12A registration. So which is very harsh. Accreted income means taxation at a maximum marginal rate on net assets. So it is very difficult. So my email ID and mobile is also there, but this is very specific question. No need of a separate PAN. Similarly, at the same time, if 12A is not a re-registration, if it is not done under 12AB, one is eligible to get that from assessment year 24-25, that is current financial year. So previous year, there may be chances of difficult chances of payment of taxes at maximum marginal rate.
Yeah. Thank you, sir. The next question is, if audit is done under Society Registration Act and not under Income Tax Act, then also audit report will be in Form 1010B. Please elaborate.
Yeah, Form 10B and Form 10BB is the audit report for charitable trust under Income Tax Act. So as per Income Tax Act, if any trust is having a gross receipt before allowing any benefits of Section 11 is more than 2.5 lakh, then it is necessary, it is compulsory for trust to get audit done and to procure report from a auditor in Form 10B or 10BB as the case may be. Okay. So if about 2.5 lakh of gross receipts, audit is compulsory for all charitable trusts, irrespective whether it is registered under Bombay Public Trust Act or a Societies Registration Act.
So, sir, in that case, if the income is less than 2.5 lakhs, then Form 10BB is not required to be filed.
Yeah, it is not necessary to get audit report under Income Tax Act.
Mhm.
For Societies Registration Act or a related state-wise act, if at all, it is a different limits are there. Say, for example, in Gujarat, audit under Charity Commissioner is only 10,000. That above 10,000 income of a trust, if above 10,000, as per the Public Trust Act, as applicable in Gujarat, it is necessary. But Income Tax Act is saying that limit is of 2.5 lakhs. So Form 10B and 10BB is for income is under Income Tax Act, audit report under Income Tax Act. So that 2.5 lakh limit as far as 10B and 10BB is there, it will apply.
The last question we have is, if a society training athletes for competing in international sports events and incurs some expenditure on the foreign trips organized for such events, whether these expenses will be treated as spent abroad and Form 10 will have to be filed instead of Form 10BB, since the revenue of the society is less than 3 crores.
Said the limit of that 5 crore and for a foreign contribution is for 10B and 10BB limitation, that the conditions are that trust having gross receipt above 5 crores, trust which has received of any foreign contribution, they are required to file Form 10B. All other cases are required to file 10BB. If trust has not received any foreign contribution, then it will, and the receipt is below 5 crore, then that trust is required to file Form 10BB. Under FCRA, if any remittance is received, I am again saying in question, I think it is asked for a payment of any foreign remittance. So payment of foreign remittance is, if it is within objects of trust, it is absolutely fine for charitable trust. If the benefits are to people of India only and within India, but if remittance is, say, for example, a school is required to pay some software charges or say any foreign university affiliation charges for students studying in India, then that remittance is absolutely allowable under Section 11 and it will not affect the applicability of audit report, that whether 10B or 10BB is applied. The 10B or 10BB is that condition applies only for foreign contribution. So if any trust has received any foreign contribution, then by default 10B or otherwise Form 10BB.
Okay. Thank you so much, sir.
Can I ask you a
it-
question?
Yeah, please.
So, is there any changes in ATG right now? They are rejecting too much, and what's going on about the ATG nowadays? I'm not much.
Rejecting, Jatinji, what is that? That now department earlier for last 4 years now, application is to be done centrally state-wise to CIT exemption. And there people understand the thing. So if now from this year, even if religious expenditure is beyond 5%, it will get reflected straightway in audit report and in income tax return itself. So this is now more usage of AI is there. So slightest any of the provisions, if it is not getting fulfilled, an application will get rejected. So one has to be very careful. If any trust is registered under ATG, they have to be careful that regarding their expenditure for religious purpose, or like means it is they have so many, department is having so much of information, and we are only giving that information. So one has to be careful. We have to be careful. Otherwise, my experience at the CIT office, that they are very liberal. They are not that strict, or they are liberal. They are taking lenient view for trust. They understand that charitable trust. Say one of the surveys that majority trust are having either one person staff or no staff. So this knowledge is with the department also, that many majority trust are doing on a voluntary basis, and trustees are not employees. They are giving their services voluntarily. But for ATG, I do agree that there is a issue, and if any of the conditions are not fulfilled, straightway rejecting, straightway rejecting.
Sir, in case, suppose as a donor, I have given a donations, and now there is some provisions that charitable
10BD and 10BE.
that they have to file the statement, and if they have not filed the statement, they will not allow me ATG. What the days to come?
At the moment, there is no mechanism available that 10BE certificate is to be downloaded by trust in their individual capacity. That is not getting reflected in a donor's 26AS or anywhere.
Yes.
So only thing that now that while filing individual return, one is required to write that document identification number, that is 10B certificate number. So if that is not mentioned, then there are all chances that one will not get benefit of section 80G, that donation made for. So we have to be very careful at the time of giving donation, that this is donor trust is uh, filing their form 10BD, and we are procuring form 10, that donation certificate in form 10B on a regular basis.
Form 10 to be obtained.
Yeah, 10BE.
Okay.
So we are not left with any other questions, and it is a very proud time that I can share. We are more than 968 participants listening right now to this webinar. So thank you, Jatin sir and Brijesh sir, for such a great interactive session. And moving ahead, since we have no more questions, I, on behalf of ICI, would like to thank, first of all, our chairman of CP committee, Purushottam sir, for such a great initiative. Gyan sir, chairman, for giving us this opportunity of having such great speakers with us. Jatin sir, Brijesh sir, for sparing your time on a regular day and enlightening us, all the participants, on such a complicated topic, where, as Jatin sir rightly said, that on a day-to-day basis, we also face issues wherein we don't get normal registration of ATG. So thank you so much on enlightening us, and thank you to the background team of CP committee for helping us with all the technical support. Thank you so much to everyone.
Thank you, everyone. Thank you.
Thank you.